Let me tell you a fun fact. Within the last 2 centuries, more than 90% of the world's millionaires have been created by investing in real estate. But if done incorrectly, without the right knowledge, required skills, or partners, it can also create a ton of problems and a lot of sleepless nights. You feel like sometimes there are way too many gurus out there trying to sell you on a weekend course or just too much noise to cut right to the facts? Yup, we did too, and this is why we started this podcast. Our goal is to provide real estate investors, entrepreneurs, and enthusiasts with all of the most recent knowledge, secrets, tips, tricks, and tactics so that you can grow your own portfolios, increase your returns, net worth, and most importantly, create generational wealth for you and your loved ones. Remember, this is your real estate career. Information is your sword and shield, so eat hearty, prepare for battle, and grind your way to victory. My name is Tejas Gosai. I'm joined by my partner, Jeremy Moyer, and we welcome you to the Real Estate Investor MBA podcast.
Welcome back to Real Estate Investor MBA. I'm Jeremy Moyer, one of your hosts. My co-host Tejas and I like to start off all our episodes with a huge thank you to our listeners. We definitely could not do this without you guys. We do enjoy hearing from you. So if you like us to review a certain topic, answer a certain question, please send those to me at jeremy@realestateinvestormba.com. I do read all those emails and enjoy hearing from you. Also, please check us out at rei.mba. You can find all of our content there. If you'd like to follow us on what we're doing, stay in contact with us, you can sign up for our free newsletter. The link is on the website to do so. And for our guest today, we had Mark Stapp. So Dr. Mark Stapp is a well-known Phoenix real estate expert. He teaches future real estate leaders at the highly ranked W.P. Carey School of Business at Arizona State University and is an accomplished real estate investor, advisor, and developer himself. As the Freddie Taylor Professor of Real Estate at the W.P. Carey School, Mark has numerous roles and titles, including the Executive Director of the well-known one-year Master of Real Estate Development Program, Faculty Director of the Undergraduate Minor in Real Estate, and Director of Real Estate Center for Theory and Practice. And outside of Arizona State University, Mark has been a part of various business enterprises and development projects across the United States for more than 40 years. He often writes columns and participates in interviews for local and national media on community development and the real estate industry. Wow, we just came out of an interview with Mark a few minutes ago, and it is packed with information. We cover a ton of topics throughout different commercial industry sectors. Multifamily, we talk about the supply and demand imbalance, where we potentially see rent growth, et cetera. So I think you guys are really going to enjoy this interview today. Love to hear from you. Let us know what you think. Cheers. Welcome back to Real Estate Investor MBA. We are really excited for our guest that we have with us today, Mark Stapp. Mark, how you doing?
I'm good. Thank you very much, Jeremy. Thanks for having me on.
Absolutely. Absolutely. So for folks that aren't familiar with you and what you do, can you just spend a couple minutes with us right now? Let us know, a little bit about yourself, how you get started in real estate, and how you ended up in teaching in academia.
Yeah, I'm not an academic, right? So I came to academia because I'm a lifelong learner, but I've been in the real estate business in various aspects for the past 45 years. And I got to ASU, where I am the director of real estate programs within the W.P. Carey School of Business, because I, as an outside board advisor and donor, helped start the Masters in Real Estate Development program in 2006. And I've got some academic pedigree that goes with me. And in 2009, when the rest of my business wasn't doing much, like it wasn't doing much for a lot of people, the dean asked me if I would be interested in taking over. And, I'm one of those people that believe in pursuing things that I have a passion for. So socially, environmentally responsible mindset. And this seemed like a good way to, use what I had for experience and imbibe other people with this mentality. So I did it. That's what I've been doing. I remained active in the real estate industry in a variety of different ways, from advisory work to expert witness work, but still own a number of assets around the country.
Interesting. So like in your real estate career, was it mainly multifamily, office? What did it kind of pertain around?
Yeah, it was really focused, well, a number of different things, actually. I can't say that I was highly focused on any one particular
Mhm.
asset class, right? So a lot of what I did from an investment standpoint was around land. So we developed probably 10, 12,000 lots for home builders, but we were actively involved in fee development across the US as a business, and it involved commercial properties, a lot of adaptive reuse and redevelopment. And that was hospitality, office, some other retail assets. But I also started a home building company in 1993 and grew it and sold it in 1998. So, it's really been a wide variety of experiences. What I've done is I've tried to pursue things that I believe in and not so much focus my attention on any particular area.
Okay. No, very interesting. Yeah. So for today's show, for everybody that's listening, we're going to cover, I would think, an often asked question, especially relevant in like today's economy. It can kind of be a little complicated. That's why we sought experts such as Mark to come on to the show and kind of unpack that question for everybody. So Mark, the question is, what are some of the biggest headwinds that you see the U.S. commercial real estate industry facing today? I mean, you've been around in the industry for a while. I'm sure you saw ups and downs in the market. Really interested to hear your perspective on this.
The economy is in an interesting and somewhat weird place. And I think that's one of the real headwinds is, especially for commercial real estate, is trying to understand where inflation is going, where the Fed is going to tackle inflation and what that means to interest rates and its effect on cap rates and valuation, et cetera. So I think that's really one of the big ones. We came out of the pandemic. I mean, we were chunking along, slow and steady kind of wins the race as we were recovering up to just before the pandemic, and things really started to accelerate. The pandemic hits and boom, stuff really explodes after got the first 6 to 8 months of the pandemic behind us. And there was some really big shifts that we're all still seeing the results of. But the question is, how long does some of these last? And some of them I think are really critical, both to the economy, to community development, and, to commercial development. So affordability in the housing market has an effect on the commercial marketplace, right? Because it affects mobility, it affects employment trends, it affects the ability to attract employees to employers in certain areas. But, the supply chain issues, the cost increases resulting from supply chain issues and other factors now, such as inflation, but, throw into this mix some of the pre-pandemic tariffs and trade-related issues, which caused prices to go up because it constrained supplies. You kind of like throw all of this stuff into this mixer, and there's still a lot of uncertainty. And I think those are some of the really big issues. Interest rates on mortgages fell because I think that the capital markets said, hey, listen, I think the Fed's going to see some softening in inflation, and maybe we'll get out ahead of this. And then rates jump back up again. We get great employment report the other day. What does that mean? It comes September when the Fed is going to meet again. So a lot of anticipation. And, I've run into analysts because it is confusing, because costs have gone up, because the interest rates have gone up, making things more expensive. They've gone, okay, we're pencils down for a bit because we got to understand this. And some of that, is good. It's wise. But in certain sectors where we already have constraints, like in multifamily, all it's going to do is exacerbate matters because that's one segment that really is feeling the effects of interest rate rises, because you start pushing people out of single family homes, they have to live somewhere. And so you get high growth markets that are constrained because single family is still trying to find its way, and it puts a lot of pressure on multifamily, and that puts a lot of pressure on affordability. And there's no good solution right now.
No, there isn't. Before our talking today, I was just writing down some notes, trying to think of some questions to ask you. And, one question that popped in my head, and you kind of led right up to it. So I'm just going to come out and ask it. It's in multifamily, the conundrum that I think we're in and the difficulty, like, pertains to the supply and demand imbalance in some of these markets, right? That operators, investors feel that they can push rents because they're able to. Renters only have so much money at the end of the day. They have so much money for necessary spending, then for discretionary spending, and maybe they don't even have any for discretionary spending. There has to perceivably be a limit to what they can afford. As an investor or an operator developer, you're looking into a market. Let's say you're not building, you're not developing, but you're looking into a market at existing property. What are metrics that we should be cognizant about to be aware of this, right? I mean, you can't just think, oh, the sky's the limit. We just can push, supply and demand. That's the all be all metric to determine the rent push. Like, in your mind, what are other some metrics that people need to be aware of? Because the affordability issue is super real.
Yeah, it is. And so let me, before I answer that question directly, give you a little bit of my perspective. And it relates back to what I said my path has been related to. And, real estate plays this interesting role in society. And I'm going to get the answer to your question by giving you this preamble. Real estate plays an interesting role in society. It is the nexus between business and society. And nothing better represents that nexus than the situation we're in with multifamily today, because it is a necessary asset for a community to have housing that is affordable to all employment classes and all people. And investors, you're right. It's one of those things that you have to ask the question, just because I can doesn't mean I should. Because what you're doing is you're taking the critical asset, which gets you value, and that is the people that live in your community, right? That rent is paid by people who live there, right? And so if you continue to strain them, what you're doing is you're impacting your community that your asset exists within. And I think you increase the risk that you have some systemic long-term problems by affecting those who pay the rent. Now, does it mean that you shouldn't? I think you have to be really cognizant of this elastic limit. So back to your question about metrics, I think you really got to look. If you're going to buy an asset in a community, I think you have to realize the fact that you're buying now at the top of the rental rates, and be realistic about whether you think you can continue, when you create that pro forma, to generate those higher and higher rents, and use that as the basis for your valuation. I think that's a risky proposition. If I'm buying an asset today, I'm going to look at the series of scenarios that include not being able to raise rents, having maybe some increased expense and some increased vacancy, and see what that does to valuation if I'm buying it today. Because I think that's a reality that you have to live with. Underwriting has to reflect the reality of the future.
I think you hit the nail right on the head there. It's interesting. One of our first, I would say 5-10 guests was a individual who's a VP of commercial and economic development, reached out to businesses in our area. Now he's actually the mayor of Allentown. And the conversation we had was very in line with what you said. Like, everything's very interconnected. The multifamily, those that live in multifamily rent, are constituents to this area. They support businesses. Their discretionary income supports businesses. So everything's very interconnected. So I love what you just said there.
There's a professor from Harvard, Michael Porter, and anybody who's gone through an MBA program knows Michael Porter. He's probably the world's leading business strategist. And, and he really has pushed forward this idea of shared value. Now, he hasn't related it directly to real estate, but you can relate it directly to real estate. And that is the idea that you have to support those that you depend on and share that value. And some of the sharing the value is maybe I'll raise the rents as much as I could, because I'm trying to, in fact, make better the place that my asset exists within. That's the interesting thing about real estate, is it's fixed. And so it is directly related to its place.
And I want to go a little different direction in multifamily for right now, and then we'll go somewhere else a little later. The supply and demand, easy question, naive question, maybe. Why don't they just build more? Right? There's as a developer, it's not just I make a decision now, it happens tomorrow. Like this is years, 5 years, 10 years
Yeah.
on the road, right? What in today's environment is risky, or developers perceive as risk or as real risk that doesn't make it a simple solution as just build more.
Yeah. I mean, developers hate uncertainty, right? So this is a business where we're making decisions today about things that aren't going to happen for a long time in an environment that's constantly changing. We have little or no control over. Right? That's a really crappy kind of business to be in one regard, right? So what are the things that really affect us? Well, land prices, right? So as the market has improved and we had this really hot market, well, land sellers look at it and go, that's great. I'm going to, continue to look at increasing values for my land. There's been a bit of a reality check for those selling land to single family home builders in the last 3 or 4 months because they're having to reset the residual values because of some constraints on costs and what they can sell houses for. Well, the same is going to happen with industrial, right? The land prices go up and makes it harder. The best land is always consumed first. So the further you get into a cycle, the more time you have to put into finding the right properties to purchase. And then you've got local regulatory environment, right? So we've got this idea of, I read this article, I'm trying to remember what it was from, but this idea of vetocracy. So it's not a democracy. It is the ability for one or a few people to be able to veto decisions at local levels. That is a really dominant thing. So you're trying to add multifamily to the marketplace because you need them, and you get a few people to push back, and it makes it hard to get your entitlements. So, there's a number of those factors that make it difficult and uncertain. Add to that all the stuff that we talked about before. You can't simply decide you're going to go build something and those units magically appear in the market. Now, we've had more single family starts, I think in the last quarter than we've had in maybe 7 or 8 years, right? So we see some of this long-term process, but take a market like I'm in Phoenix, like we're underbuilt by 122,000, 125,000 units.
Wow.
Right? You don't make that up in a year or 2 or 3. And when the market is continuing to expand because we're having a lot of job growth, it's hard to ever make that up because we're increasing demand at the same time we're trying to add. So these are tough factors. And unless there is really significant policy change to support additional development that we really need, it's tough.
No, I agree with you. It's not an easy answer to that question. No, I appreciate your insight though. You touched base very early on about the Fed and the uncertainty with what are they going to do, with inflation. Obviously, they're trying to tackle inflation. Curious to get your opinion. How do you think they're doing to date? And then do you think there's a limit? I mean, there has to be a limit at some point, but do you think there's a limit on how far they're willing to push their federal funds rate to tackle inflation?
Well, I mean, in theory, there's no limit. I think the limit is really determined by the effect. And so interest rates are, as they say, a rather blunt tool. It is not for precision execution. And that blunt tool had a bit of shock and awe earlier in this year when they raised rates. And the question is, what do they do? I think we're going to have to wait another probably month or two to see the effect, because of all of these metrics that we're depending on, most of them are backwards looking, right? So we're looking at July information to make decisions today. And so I think we've got to wait for the effect of this to trickle through the economy. Most of these things don't have immediate effect, right? They have a lagging effect, and it's going to take a while. So September, I think, is important. There's not a limit. We can all guess, right? That's all I got is a guess. Will they raise another 75 basis points, or will it be 50? Or will it be 25? Because we still haven't got some of this under control. It still has a negative effect in some regards. So I think it's yet to be seen. We just don't have enough data looking at the effect of the rates that they've increased already.
You know, we spent a lot of time on multifamily. Most of the interview actually was on multifamily. Do you have any insight on different headwinds potentially on some of the other sectors like office or retail or hospitality or, you know?
So office is really tough, I think, for a variety of reasons. So something that's happening is we're now beginning to see the effect of Generation Z on the employment front, right? So those are people that were born in roughly 1997 to recently. So they're like 9 years old to 24, 25 years old right now. And they have a different view of what their life should be. And that's going to have an effect on employers trying to attract talent. And that's going to affect what they do in regards to one, types of office, so flex office space, amenities, those kinds of things, I think are still being sorted out. Us old guys, you know, are going to increasingly leave, although we've hung around a lot longer than people thought, right? And we still have a bunch of years to go. But this transition is, I think, causing some uncertainty in the office market. I think there's a flight to quality. So you still see some development and growth, but it's a product that is high quality in well-located places. I wouldn't want to own Class B or certainly C office. I think that's ripe for redevelopment in something different. The industrial market, you know, I think is going to see the benefit of some of these policy changes. You know, so take the onshoring of semiconductors, you know, chips, right? That's going to have a big effect because there's ancillary businesses that relate to that. And so you're going to, Metro Phoenix, for instance, is one of those markets that's going to benefit greatly from this significant push. It's going to help continue to push the industrial side. But back to something I said before, costs have gone up. Land prices have gone up, you know, financing costs have gone up. So it's going to make it harder to make some of those deals work. And so you've got these two competing forces right now. But I think that there's a lot of tailwinds still for industrial. And part of the reason for that is also, you know, retail continues to improve. And as we look at technology and we look at consumer behaviors, we're still seeing some of that play out. You know, Amazon, a lot of development. Will that slow down? We've got other friction points that we may be able to solve through industrial. Retail, I think retail depends on the kind of retail, right? So you see a lot of repositioning or demolition of the old regional mall, strip centers that are really focused on good neighborhoods, where you've got, you know, consumer services like nail salons and hair salons and massage, those kinds of things continue, I think, to do pretty well. And then the repositioning of the malls, the really good, well-located malls that are addressing, you know, what we need in communities. And to some degree, it's interesting to me because you start to look at the kinds of things that are in malls and it's beginning to look more like the old Main Street kind of thing. So you're adding housing, right? You're adding employment. You're mixing uses much more so than you did at the advent of the regional mall. So I think it's some of that transitions. Those are good. I think positive tailwinds for some of these.
Oh, interesting.
Headwinds. The headwinds are the economy, right?
Yeah.
What happens with Ukraine? What happens with China? What happens with Russia? You know, real estate is symptomatic. It's symptomatic of changes in demography. It's symptomatic of changes in global economy that affect local economies, migration patterns. That's what makes it a really interesting subject matter.
No, it really does. No, thanks for that perspective. So crystal ball time, no one's going to hold you to this. I think you kind of touched base. I'm assuming maybe some of your answers, but I'm curious to hear it. Like 1 to 2 years out, 7 to 10 years out, you know, what different asset classes, you know, would you place potential bets in?
So here's a preface. Right. So I have a graduate degree in urban economics. And one of my professors in a class that was looking at population makeup and growth said to us, those who know how to predict the future know better. Okay. So with that in mind, it's easier to try and predict 2 years than it is 7 to 10.
Sure. Yeah.
But, you know, politics is going to play a great deal into what our future looks like. And that's something we haven't touched on. but it can have a profound impact. 2 years, I think we're going to have a tough time, continue to have a tough time for the next 2 years. And this is where politics comes into play. Probably right about the time 2024 rolls around, the economy is going to look different than it does right now. That assumes nothing bad happens with China. Nothing further bad happens with Russia, and that finds a close in that conflict that isn't destructive to the rest of the world or Europe. I think it's fairly positive. Between now and then, those asset classes I was mentioning, I think continue to do well. It's the housing, the segment that I'm really kind of worried about. 7 to 10 years from now, Jesus, it's a crash. I don't know. I think you've got to look at the values of the Gen Z population to understand how the need and use of real estate is going to change in the next 10 years, because they will increasingly become the dominant force in the marketplace. So we still don't know. We know the things that have affected their lives, that affect their values. We know a little bit about how those are playing out in the decision-making, but we don't fully know it yet. So
it's all about the data, right? Yeah, absolutely. No, perfect. So Mark, in closing, how can our listeners, get in touch with you if they want to ask you questions, just stay in contact with you, follow you on social media? What are the best outlets for that?
Yeah, I don't have a big social media presence. I got too much to do, and I don't have anybody that follows me around and tweets for me, stuff like that. So, probably Yale is the best, and it's very simple. It's mark.stapp, S-T-A-P-P, at asu.edu. I'm happy to respond to emails. I'm a fairly good email buddy. I appreciate the opportunity to be on the show and to talk to you and have an open conversation. This is great.
Absolutely. No, I appreciate you accepting our the invitation invite. This was wonderful on my end as well. So once again, this is Mark Stapp. I'm Jeremy Moyer with Real Estate Investor MBA. Please be sure to tune in with us next time. We'll see you then. Thank you.
Thanks so much.